Call our meeting to order. We're a few minutes late, but we'll come to order for the Finance Committee for today, Wednesday, the April 20th. We have a number of items on the approval list, and one of them I want to call attention to that I'd like to take off of our agenda for today. I don't think we've done our homework on it yet, and I need to read through it more. That's item 4, and I'd like to move that to take it off the list for today. It's really what I'd like to do. And Commissioner Cook, with your endorsement on that, we'll defer that to
That's fine. I'm perfectly fine with deferring it.
Okay.
Yes.
We'll defer to next meeting then.
Yes.
And just for general knowledge, I was deferring on having that because I wanted to have Commissioner Stevens available too, but
Yes.
he is delayed, so we'll move ahead. So with that, we'll go back to the top of the list. Having adjusted our approval list, we'll go item 1, minutes from the meeting of the 16th.
Mr. Chairman, I'll make a motion that we accept the minutes as presented.
Okay, and I'll endorse that, and so with a show of hands, we'll endorse that. Completed, then the fiscal year 2023 annual budget. Mr. Burrows, you're on.
Yes, sir. Okay, last meeting, we discussed the annual budget. There was some feedback provided by the commissioners, so we tweaked it a little bit. However, it is mostly the same as what were presented at the March meeting. Let me get through the actual packet here. We did provide, at the request of the commission, the proposed budget, what the projected based off of 9 months worth of expenses are versus also what the FY21 actual expenses were for your review and consideration. There we go. All right. So our goals going into this year's budgeting process, we had 4 goals. We wanted to maintain our affordability despite rising costs. We've seen it in our projects. We've seen it in our day-to-day expenses with huge increase in cost across the board. Major areas where that's occurred is on our chemicals and on pipe and fittings. We're seeing major increases. We know we have the master plan. We want to continue to take care of those projects. So our goal was to increase our project funding so that we can maintain that master plan that we worked diligently to create last year. We want to improve our equipment reliability. That's for 2 reasons. 1, we want to make sure that our equipment that we own is functional, but 2, we know that availability is becoming a concern if we have issues. We want to make sure that's being maintained. And then we want to always try to streamline our operational processes. So some highlights for the budget. One of the things, we're not talking about the rate resolution today, but we should want to confirm with this budget, we will be requesting a water-only rate adjustment to fund this budget, and we'll go over that in a minute. There is a repair and replacement reserve. That's that master plan project funding reserve increase. We're increasing our capital costs to replace some of our dated equipment, and so that we have more reliable equipment. And then we've also got about an $80,000 reduction in budgeted overtime, which is always encouraging to see. I consider overtime to be a pretty good management goal to try to reduce that, and so we're seeing a reduction in that. So our budgeted revenues for FY23, see kind of the pie chart we've got here, about 41% comes from sewer, just shy of 21% comes from water. The other 2 major charges that are on everyone's bills, the administrative fee, which is per bill, that's about 19% of the budget, and then the debt charges, which is per REU that your account has, so all residential customers are 1 REU, that's about 13% of our budget for revenues. Other income includes a lot of the service fees, the operational fees that go along with tap fees, and also like GFA loan forgiveness is included in that. That's not budgeted, but those type things, scrap sales, all that ancillary income that comes in. A small amount budgeted for interest gained on our reserves, and then planning and construction has fees for reviews that are coming in, and that is a very small percentage of our budgeted revenues. Our revenue highlights, we've seen tremendous growth in our system. This fiscal year has 510 new service locations since July 1st. And since last year's budget, which we presented in March and April of last year, we've had 677 new locations started in our system. So that has showed an increase in our revenue projections for next year. The water revenue increase will require an adjustment only on the high usage, 6,000 gallons and more. So for your standard residential customer, no change in your bill. And then we do rent space on our water towers for cell carriers, and we're seeing an increase in what we're getting for revenue off of those cell tower rentals.
Are those done under contract for a period of time?
Yes, Suez, yes, Suez manages that for us. They handle all those contracts and maintain those rates, and they are constantly doing that. But yes, they sign contracts for guaranteed revenue for a certain amount of time, and then when their contract's up, that gets renegotiated. And luckily for our purposes, that tends to be renegotiated in our favor.
I think so. Right.
So our water rate adjustment, what this would be to increase for just that usage rate that exceeds 6,000 gallons a month. The average residential water customer uses 4,200 gallons a month. So who's this going to impact? Well, if you irrigate, most likely you're going to have to see an increase in your bill. Also, commercial customers would see a small increase in their bill because it's hard for restaurants and things. Industrial customers use less than that. So what it would be, the column on the left here is what the current rate is. So that's $3.61 for the per 1,000 gallons for that block between 6,000 and 20,000 gallons. So that would be going up 56 cents per 1,000 gallons in that time frame. And if you're above 20,000 gallons, it's currently $4.32, so that'd be 67 cents per 1,000 above 20,000 gallons usage. So here's your combined bill if you're a water and sewer customer, what you'd be looking at. Low-use residential, we have some customers low-use, whether they're single or just a couple people in the house that use, say, 1,000 or 2,000 gallons in a month. No change in your bill. Our average mid-use residential customer is between 4,000 and 5,000 gallons. You use 5,000 gallons, no change in your bill. If you're a very high-use residential customer or you do a lot of irrigating, you may use 15,000 gallons in a month. Your bill would change $5 if you're using 15,000 gallons in a month. Smaller restaurant, commercial enterprise, 5 REUs, you're seeing a $21 increase. If you're a chain restaurant, this is a sit-down chain restaurant example, it's a $60 increase. And master meter multifamily, this is an 8-inch meter that feeds a apartment complex that's got 124 units, so you're seeing a $200 increase in the bill. That's billed to the apartment complex, not to the individual customers. So our expenses budgeted for next year, you see about a third goes to personnel, about a third goes to operating, and then that last third is split up, very small percentage for the governing body. 23% of our budget goes to reserve transfers. That sounds bad, but reserve transfers is where we do projects from. So that's our project funding. So 23% of our budget goes to doing capital projects next year. And then debt service on our existing bonds and loans is 6% of our budget.
Can I ask a question? How would that compare to other utilities around the country, the debt service part, the percentage?
That debt service is much lower than what you would see at most other utilities.
Yeah, I think
much
that
lower.
looks like a very low number.
It's way lower compared to the revenue that we take in. The ratio is thought to be good, is having about twice as much debt service, twice as much owed as what you can produce in revenues, and we're well below that.
Yeah, I could see that.
Between 1 and 1.5 multiple.
Yeah, I was at a conference a month and a half ago where they were talking about utilities that were running 40% of their budget being debt.
Right, yeah. I thought this number looked very, very low.
That is not uncommon to see 30 to 40%. Yeah, some of them's up to 50.
Really, 50%?
The utility I'm talking about was a very large utility in the state of Colorado, and they were issuing bonds that got them up over 40% of their budget as debt service. So our expense highlights for the year, of course, a third of our budget goes to personnel expenses. So last year we budgeted for 156 positions. This year we're budgeting for 154 positions. We've eliminated 2 positions by combining some duties. One of those is in our admin services group. We had a position called field service investigator that those duties have been offloaded to 2 or 3 different people, portions of that duties. And then we are actually reducing our water operator count by 1 because the way we've changed our schedule, we are able to do it with 1 less person. We still have 6 water operators, more than required, and we can keep them all busy for that amount of time. So proposed COLA cost of living raise These are large numbers, but we know we're living in high inflation times. The proposed hourly cost of living raise is 6.88% for every one of our hourly employees and salaried employees at 3.44%. However, despite those cost of living raises, because of changes we've made recently to our insurance, our pension, the overtime savings that we've had, the staff reduction that we've had over the past few years, we're actually showing a cost decrease in budgeted personnel expenses, even including those cost of living raises.
So, question here is, we've basically squeezed some more efficiency out of the organization by eliminating some vacancies and redeploying some of the responsibilities to existing staff. And while we can respond with salary and hourly increase in pay that's comparable, presumably, to the market area.
Right.
That, in your view, that it allows us still to drive costs down, but we still need to have a modest increase overall to fund the budget.
That's correct.
Okay.
That is
Thank you.
100% correct. So on the COLA, I used the calculation for the consumer price index for the South only. We didn't want to include what the cost of went up in San Francisco and New York in that calculation. So that's for the South only. Our average COLA would go to hourly employees is $1.52 an hour. Now, we've got 130 hourly employees, but $1.52 an hour. And the average raise for our salaried employees based off of current salaries is just over $3,000 a year. And again, these raises are funded by savings and overtime, insurance, pension, staffing reduction. You remember we just changed the uniform policy. We're saving $60,000 a year on uniforms now. So all of that's done from our efficiencies we've gained.
So this cost of living increase is going to be added to their salaries
That's correct.
going forward?
That's correct.
So next year, now, what about the merit raises? Do they?
Now, what I'm proposing here, because of the percentage, what we've done in the past is the cost of living raises have been below 5%. We offer merit raises. For hourly employees, there would be no opportunity for a merit raise above the 6.88% this year. For salaried personnel, there would be an opportunity to get a cost of living raise up to a merit raise up to a combined 5% with the cost of living.
Okay.
So, by division, and I apologize, I'm having a contact issue all of a sudden. Budget expenses by division. You can see where we're spending the bulk of our money. Wastewater treatment, systems pumping and maintenance account for just shy of 50% of our budget, our operating expenses. Finance, 14%. I will remind you that that includes the entire group insurance charges for the entire organization. Since we went self-funded, we don't get the information on which employees' expenses that are, so we included that all into the finance budget. And then admin and water distribution, around 8% of the budget, and then water production at 6%. Some of our more administrative type functions, planning and construction, purchasing, office of director, and governing body, of course, being much smaller percentages. We want to keep the most of our money out fixing assets in the field. So what's driving some of the increases we've seen in our budget? Like I said, chemicals have went through the roof. We've seen 3 increases in the past 18 months on oxygen of at least 12%. So we're almost over 40% in increase on a unit basis on oxygen. We have improved our efficiencies on oxygen, but there's only so much you can do with a 40% increase. And from what I've been told from other utilities, we're pretty fortunate to only be at that point. They've seen some bids come in 150% of what it was the previous year. So that's becoming a real issue in our industry. We talked about at the last meeting, our property and casualty insurance, market-driven increases we talked about at the last meeting. It went up because of the risk profile of our area, not anything we're doing. And then one thing, this is not an increase, but it's in a different line item. So if you look at those line items I showed you, it looks like we're spending a whole lot more money on postage, but that's because previously that postage amount was included in the bill print cost. We're separating that out so we know more truly what the cost of actually farming out the printing is. The postage is going to be what it is no matter who we use. And we're also trying to, of course, incentivize people to use paperless billing to try to reduce that postage as well. Other increases, equipment, parts, and supplies. Previously at the wastewater plant budget, that's the 4,335, 337, 338, and 339 budgets. we had many line items for belt press, clarifiers, digesters, aeration bases that were all separate line items. We were using our budget to kind of help track our asset management costs on those items. We've combined all those into one called equipment, parts, and supplies. We have a work order system that tracks our asset expenses. There's no reason to do that through the budget. It simplifies the budget, and then we don't look at the end of the year and say, well, we didn't spend any money on the clarifiers, but we spent too much money on the aeration basins. That way it's just plant maintenance as a whole. Purchase of electrical services, you'll see a budgeted increase. We lost a licensed electrician in the past year, so we're having to farm out a lot more of our electrical services, trying to recruit an electrician if anybody knows anyone. And then repair and replacement reserve, we're seeing it. We did budget an increase in that. That's to maintain that master plan funding, and also, as we talked about in the facilities committee meeting, construction costs have increased as well. So decreases. We talked about the postage being reallocated from bill printing and mailing, so it looks like our bill printing costs went way down. Dunbar Creek electricity, we've got one basin out of service, and what we found is we can operate with one aeration basin, so we're running less blowers, so we're not having to turn over high horsepower blowers all the time. So you're seeing a reduction in budgeted electricity. With the ongoing project we've got going out there before the end of this fiscal year, we expect to see an even larger decrease in that. And then we saw major overtime reductions in systems pumping. That's hugely driven by the new SCADA system. Used to, we were getting a lot of nuisance calls. They'd have to go check it out because we didn't get good connectivity. The new SCADA system, we're seeing a huge reduction in overtime there. Administrative services, we're reducing some of that, some of our, the way we're doing our customer service and our field crews as far as turning the meters when somebody needs a meter turned on and off. In water production, we talked about reducing that one position. We also reduced the overtime in that by having crews that are scheduled throughout the week instead of just Monday through Friday. We have personnel scheduled on the weekend, so that reduces the overtime needed on the weekend for that. In our expense history, I will point out this excludes capital purchases. Capital purchases are vehicles and equipment that we have. This is just a kind of a trend for the past 5 years. You can see the green part is the operating expenses. That's what our individual budget managers manage, and that's remained mostly flat for the past 5 years. The blue part is your debt service. So 5 years ago, we were at 3.8 million. We're at 2.9 million now. And then even next year with the new bond coming online, it's still going to be at 2.9 million. So a reduction in debt service over the last 5 years. And then this R&R transfer, we hear the word reserve and think transfer is a problem, but again, this is where we do projects from. So 5 years ago, we were budgeting $4 million a year for projects. We're at $7.4 million a year in projects now, budgeted transfers plus, other funding sources. So that's just the budgeted from the operating expenses. So that's allowing us to make a bigger impact on our system, and also allows us to punch well above our weight than what most utilities are able to do in projects every year. So a couple of key equipment replacements I want to talk about. Combination cleaner, what we call vac trucks or vac cons. The official title for those are combination cleaners. We have 4 vac cons in our system. That's where we do all of our gravity line cleaning. Those were bought on a capital lease to own program previously, and we're recommending redoing that capital lease to own and trading the existing ones in. We can get about $125,000 in trade-in value per VATCon right now. So essentially if we trade in all 4 of them, we get a buy 3, get 1 free deal. So 4 of them will cover the cost of 1, and then we'll do that capital lease to own. So maintaining the program, even with equipment costs have increased, the fact that we've maintained them well, that only increases our budget for that by $11,000. So for $11,000, we get 4 new VATCons.
So the timing of the replacement, you're doing this to avoid major maintenance item.
Right. So right now,
additional hours use.
That's what I was going to say on that last budget. We're spending, and now these vehicles are 5 years old. We're spending $20,000 a year on each one of those right now, and that's just increasing. Those trucks suck up a lot of grit and a lot of debris, and it's just they get worn out. And the good thing is we're putting them to use. So these are large pieces of equipment, but they're being used. We jet. Essentially, the last couple of years, we've been averaging about 65 miles of jetting a year, which is roughly from here to Savannah. And some other ones, enterprise data center upgrades. Now, Commissioner Cook can probably explain this better than I can, but our servers have reached the end of their life, and they're starting to have reliability issues. Some of that's inconvenient for us, but the one that houses the billing and financial software is also having issues, and that means we can't take payments in the lobby sometimes. So getting those replaced would be a big help for us. A manhole scanner, this is a piece of equipment we can lower into a manhole that will give us a complete profile of the manhole barrel section so we know what has to be rehabbed. And so that will improve the accuracy, allow us to be more specific when what we're bidding out for these unit quantities to get them rehabbed. And also, major win for us here, eliminates confined space entry to go into the manholes to actually inspect them. And then a sonar sewer main inspector. This is a way to prioritize what we're televising with our sewer pipes. Essentially, you put a sonar emitter in one manhole and a receiver in the other manhole, and it will tell you the amount of sonar waves that reach the other side, so you can tell what percentage the line is blocked. So instead of jetting lines and televising lines that obviously don't have any problems, we can stick this in there and it goes a lot faster. You can jet about 3,000 to 3,500 feet of pipe a day. They estimate you can inspect 12 to 15,000 feet of pipe a day with this device. And then other ones, refrigerated samplers. The new permits we're getting requires flow pace sampling. So based off of what the flow rate is at that time, the flow rate at a wastewater plant changes throughout the day. So they want you to take your aliquot sizes depending on the percentage of the flow that's coming in at that point. So we have to do that. The refrigerated samplers right now, they're going out every hour based off the flow rate and measuring out individually what size aliquot they need. That's a very time and labor intensive process. So this will allow that to be automatic. A telehandler, right now we have raw sewage pumps and aeration mixers at the wastewater plants that the only way we can pull those is to hire somebody to drive a crane over there and give them a 4-hour minimum to come out there for something that takes them 15 minutes to actually pull out. So buying a piece of equipment will significantly reduce that and give us flexibility. And then fleet replacements, we're recommending replacement of 10 vehicles over the next year. Of course, some of that is 100% depending on availability of vehicles. Assuming we can get 10 vehicles, we're recommending replacement of 10 vehicles. And that is all I got in case, well, of course, we have all the data if anybody's got any questions.
On the vehicle replacement, these 10 that you're wanting to replace, I'll ask a leading question here. These are ones that have met certain milestones for the mileage or hours on the vehicle, which tells me that we've operated them within the manufacturer's parameters and maintained them up to that point.
Yes, it's not just mileage or hours. What we also look at is what are our costs to maintain. Are we spending more money maintaining it every year? If we see that start to increase, that's when we recommend replacing the vehicle before it gets to the point where we're spending thousands of dollars a year on a $30,000 vehicle.
Okay, to reinforce the understanding is we've met our hurdle rate that we set based on our maintenance practices.
Absolutely.
Okay, thank you.
I have a couple of things. On the money that's allocated for for employee salaries and benefits, I'm not 100% comfortable with taking the leftover from that and transferring it over into the R&R. I think that the situation this year with the cost of living increases and everything shows that we probably need to save that money into that same pool and use it as carryover and stay in that budget line. That's what I feel like would be useful, so that we have some reserves for employees. Because right now we're having a hard time retaining employees. We're having a hard time hiring employees, and it's not unusual because everyone's having those problems. But I think that what we're going to have to look at is what everyone else is looking at, is that employees the salaries haven't kept up with what's going on in the world. And our employees, I think, deserve to have that look so that we can be competitive. I went on to Indeed.com this morning, and it's just shocking, the number of jobs that are available in the area and what we're competing against, and good paying jobs. The dishwasher at Fletzy is getting paid $16.54 an hour, and that is going up October 1st to $19.54 an hour. Not that that's a very appealing job, but it's a job and a steady full-time job. So they serve 5,000 meals a day there, so I guess there's plenty of need. So I think that's one of the considerations we might have, is we have a tendency, because we do a lot of repairs and replacements of our equipment, that we might want to hold that money back, like when we don't have a finance director, we don't have a finance manager, and we have the money allocated, and that money kind of just goes into somewhere else. And I think it might be good to hold some of that money back so that we can keep an eye out for our employees. And I know that we don't have that study done that we were working on, that Commissioner Stevens had wanted, the compensation study, the total compensation study. But I think it's really important that we get something like that done, and that we consider the fact that we need to think about what's going on with employees and retaining them.
I think that's a very good idea, and if we are fortunate enough to run a surplus at the end of the year and we have available funds for transfer, we could look at creating some type of employee compensation reserve or some other reserve that we could transfer money into if we have issues in that regard moving forward.
Yeah, I don't have a problem like with paying down the pension obligation. I mean, that's along the same lines, but somehow or another, when the employee salaries that don't get used get transferred to buying pipe, I think that kind of like there's a separation there that I'm not 100% comfortable with.
Sure.
And I think it might be better to hold that money there so that we can think about ways to keep our employees. And I don't know what that is. I'm sure management here could come up with all sorts of creative ideas.
Sure.
But I think that's really important. And I know our guys, I mean, as much respect as I have for the people that work in this building, I think I probably even have more for these people that are standing out in the field.
Absolutely.
In the rain and the sun and the thunderstorms and the cold, and up to their knees in God knows what, out there working so hard. And I have awful lot of respect for them. And I think we need to consider them and really be sure that we need to keep these people that are doing a good job for us.
Understood. Yes, sir.
With that, Commissioner, would you like to offer
I will.
a motion for
Sure.
endorsement?
Let's see, I move that the Finance Committee recommend the full commission take the following actions. 1, approve submission of the proposed fiscal budget 2023 JWSC budget to the City of Brunswick and to Glynn County for the review and comment. And number 2, approve the fiscal year budget 2023.
That should be 3, yeah.
I'm sorry, JWSC budget in the amount of $34,400, subject to revisions resulting from comments received from the City of Brunswick and/or Glynn County.
I endorse that motion, and
Well, before we vote on that motion, could we amend that to the $34,400,000 instead of $34,400 on the annual? You said $34,000.
$34,400,000.
That's going to be very
I'm
hard
sorry.
that's going to be very hard to hit next year.
I think you were ahead of me there. I'd already put 3 zeros on the end of
Okay,
that.
$34,400,000 is the correct term. All right.
Just to comment, I think that's around the 3% and change over what we've had before. Given the challenges we experienced in this past year, I think that's quite modest. So kudos, Andrew, to you and your team for coming up with a recommendation. I think it's very sound and actionable going forward. So with that, Commissioner Cook, shall we endorse this to pass on to the full commission for tomorrow? And it does.
I would like to thank Ms. Wilson and Ms. Roberts. They do the majority of the heavy lifting on the budget for us these last couple of years, so I appreciate their effort over on these.
We appreciate it.
And then item number 3 is the capital projects plan, and we heard that at the last meeting, and it was recommended for approval. So without going through a lot of detail,
Sure.
Commissioner Cook, with your concurrence, we'll just act on it.
All right, I'll move that the Finance Committee recommend the full commission endorse the fiscal year 2023 capital projects plan as presented.
I endorse that also, and so we'll show of hands to pass that along to the full commission for tomorrow's review. And then we'll go to item 5, leak adjustment request.
Yes.
Excuse me. Yes, sir. The first, we have 2 leak adjustments. We'll talk about them individually because, of course, you could decide to grant one and not the other. They're in your book. They're stapled separately, so you can just follow your staples. The first one is McDonald's on Altama Avenue, had multiple leaks at their location. How many of them were large enough to contribute to the actual leak adjustment, I do not know, but they hired a plumber and they found a lot of leaks. So they got those replaced. You see there in June and July, they had some large values, 6.6 times and 4.4 times per the Glynn County ordinance, or City of Brunswick ordinance in this regard. Anything over $2,000 has to be presented to the commission. It has to be more than 2 times their monthly average, which this met. So the calculated leak adjustment for the customer is $2,463.87. They have paid in full for their bill, so this would be a credit on their account.
I move the Finance Committee recommend the full commission approve the leak adjustment in the amount of $2,463.87 to the account of McDonald's as presented.
I'll endorse that also, and we'll show of hands, so we'll pass that on. And then the second one,
Travel Center of America operates a travel center down on Dungeness Drive at exit 29. You see the usage patterns there. You cannot see bars for the first 9 months because the ratio was so low. They had a major irrigation leak on their property and ran up 43 times their normal bill one month and 17 times the next month. So the calculated adjustment's $3,389.08. Like the McDonald's, Travel Center of America has already paid their full balance off, and this would be a credit towards their account, which based off their normal usage means they probably won't be funding a water bill for several months moving forward.
it seems like when you consume 200,000 gallons, that they might have seen some of that on the ground.
You would assume so. Now, I will say I frequent that establishment for gas, so I never noticed a leak out there, so maybe it was behind the building or something, but that is a lot of water to go on the ground.
Wow. And presumably we don't have the new meter installed on that account.
Not yet. This one has not been installed yet, but maybe one we want to recommend moving to the top of the list.
Well, again, my thoughts on another use of our new metering system is to be able to provide the notification so that we won't have 2 months usage in that way, and that we should probably evaluate our policy such that once we provide the notice, it's on them to get it fixed sooner than later, lest they hazard the opportunity for reimbursement.
I will say on that, just as a note, we this week mailed out over 300 letters to customers that we've got on the new meters. We've got about just shy of 10,000 meters as a report of the Facilities Committee. We've got over 300 that are showing continuous consumption. So we've started mailing them out. The goal is to get to where we call all those people, but the numbers right now are a little too high to make phone calls to everybody. So we're going to send letters and try to get that number down, and then when new continuous consumption shows up, we'll start doing the phone calls.
Okay.
All right, I'll move that the Finance Committee recommend the full commission approve the leak adjustment in the amount of $3,389.08 to the account of Travel Center of America as presented.
I'll endorse that, and a show of hands, and it carries, so we'll recommend to the commission. Item 6 is equipment purchase, and we heard this in the last meeting, and it was endorsed there, so I'll just move to.
All right. I'll move that the Finance Committee recommend the full commission approve the purchase of a Kubota 30-inch cold planer from Sapelo Equipment Company, LLC, in the amount of $24,999.
And I also endorse that again, and show our hands, and they'll move to the full commission tomorrow. So, last item is the financial statement for March 31. Ms. Wilson.
Good afternoon, gentlemen. Before us, we have the financial statements as of March the 31st, 2022. First up, we have our balance sheet. Nothing really out of the ordinary for our balance sheet. Page 1, I have highlighted a few talking points. Accounts receivable balance is $1,323,969. I would like to note that the allowance for bad debt was $218,898 as of June 30th. As of March the 31st, it's $158,000. This is due in part to the LIWAP program. the low-income household water assistance program. Since January, we have had over 225 customers that have participated in this at a total of over $108,000. So that's good news. Insurance or prepaid expenses, it's our insurance renewal that has caused that to go up to $514,000. That is when we pay those invoices, that goes into unexpired insurance, and then we allocate 1/12 each month throughout the year. Capital assets, construction in progress, we're at almost $36 million. That's up almost $14.7 million since June the 30th. Under current liabilities, we have our retainage payable. That's up to almost $1.2 million, and again, that reflects the progress in our projects.
I'm trying to get that down, but they won't put my screens in, so.
Page 2. Pension liability, again, the difference from June 30th to March is that $300,000 that was pre-funding for our pension from last fall. Any questions on the balance sheet?
Proceed.
Page 3 is our summary revenue. We have net operating revenues of $1,288,725. We are over budget on our administrative fees. This is due to growth. Our calculations as of each point in the budget year, our calculations are based on the number of customers at that time. So we've had growth in our system. Interest income is over budget, but we did have conservative projections, and we've also had some maturities that have come, some securities that have come, that have matured. Other income, the GFA loan forgiveness and rental income, those were not budgeted items at the time that we prepared our budget. And our capital improvement fees, we're at a little over 2.1 million. This time last year, we were almost 1.5 million. So significant growth. Any questions? Page 4, expenses by division. We are under budget by $567,000. That is due to a variety of reasons. Our governing body, our legal fees are down, but we are still anticipating some statements to come in. We have some vacant positions across the board, and with those vacant positions, also comes it affects the benefits. The overtime budget, the group insurance is below estimated cost, and I have a update on that in just a moment. Some infrastructure repair, pump parts, odor and H2, also cost down right now. Wastewater, we had some unanticipated operating costs replacing the VFD cabinets, and that caused that one to be over budget. And of course, we have almost $1 million in POs out there, trying to get some lead time on some products. Any questions? Page 5, group insurance costs through March the 31st. Our year-to-date budget is $1,354,500. Our year-to-date actual expenses, $1,148,650. So we're under budget by almost $206,000 at this time. We're a little higher this year than we were this time last year by like $64,000.
64,000 this year?
We're up, yes.
Yeah, of course, there's probably more people using medical services at this point, yeah.
But 64,000, that's not a huge difference
No, it
from
isn't.
last year to
That's
this
true.
year.
There's 110 covered employees
Yes,
and their families?
And their families, of course,
Yes.
so.
Yeah, and their families, right, yeah.
on to page 6. Supplemental schedule of cash balances. I've highlighted the general checking account and the payroll. This is just a little buffer we keep in those accounts in case we have some unexpected disbursements, that there's always something there to cover those little checks. The group insurance is usually at $29,000 as a minimum balance. We had some payables those last few days, so we booked an entry for that. Page 7, we have our SPLOST account. We're at $1.5 million on SPLOST. Customer deposit reserves, 2.6. We are still refunding deposits to customers who meet the criteria for a refund. So that's kind of staying steady at a 2.5, 2.6. So our total cash is $73,625,600. Any questions? Page 8 is our project report. Again, we're at 35 million 900,000. In our in-progress projects, including GFA, is over 17,350,000 for this year. And that's including our capital, our current projects, and those few capitalized projects. And we have another one that is the safety project safety complex is completed. We're just waiting for it to cycle through.
Just a comment here, Andrew, tomorrow for the full commission, I might suggest that you offer a very brief update on our SPLOST projects.
Sure.
In that, I mean, you shared that with us today in the facilities, but kind of showing where we're going to land in the next 60 to 120 days, for example.
Yes.
And page 9 is just a highlight of the expenditures, that $17 million in expenditures. We have 2.87 in the R&R, the capital improvement fund reserve, 1.2 million. SPLOST is a little over 5 million for this year, and our GFA projects are a little over 8.1 million. Any questions or comments?
No concerns here.
Oh, I forgot to roll the page.
Thank you. Thank you very much. It's always encouraging when we look at the numbers, we know where the investments are and where the variances are, and it's pretty easy to understand those. Commissioner Cook, any thoughts?
No, I'm just glad to see everything is moving along correctly.
Mr. Chairman, anything for you? Hey, Andrew, anything?
The only thing I was going to say on the project report, she had highlighted that last year's project expenses were just north of 17 million, 17.2, I believe the number was. And this year through March, we're already over 16 million. And we've got some large invoices expected in the next 3 months. So we're doing a lot of project work right now. That money that we're getting to do that is being reinvested as fast as we can do it.
That's great. All right, with that, we are adjourned.